Hello everyone and welcome to this video for a quick revision for CA Inter Liquidation of Companies chapter in your advanced accounts. As always, we would be doing a quick revision here, not really solving sums but running you through the basics of this chapter. So this is a chapter which is on liquidation of companies, typically comes in your exam for around 5 and sometimes 10 marks as well. There are three main aspects in this chapter. First, there can be the preparation of what you call as liquidators statement of affairs. So this is a fairly detailed question. Then there is a question which is possible on liquidators statement or final statement of account, and then a couple of small topics which can involve calculation of liquidators remuneration or calculation in case of sharing of securities, in case of overriding payments are covered. Apart from that, we also have a separate topic where the contributions received from B list contributors. This has come, I think, twice in your exam, so I would rate this as important. The initial part of the chapter focuses on long format questions like liquidator statement of affairs. Having said that, they have not come as often in your papers. You have small questions which come from B list contributors, liquidators remuneration or overriding payments, etc. But we will run through everything. First of all, what is liquidation? Well, liquidation can be treated as winding up or dissolution, which is done either as per the Companies Act or the Insolvency and Bankruptcy Code. Both of these are to be studied at length in your CA final law syllabus. So we just need to note the background for liquidation based accounting can be based on liquidation which is conducted as per any of these laws. Now, when a liquidator submits or when a company wants to go ahead and do the liquidation, like you might have probably seen shows or you might be aware that when a company needs funding, it has to kind of prepare a pitch, it has to give projections, and based on that, it does get funding if the investors like. In a similar way, if a company has to close, they have to appoint a liquidator, which can be a talented chartered accountant like you. They can be appointing a liquidator or a liquidator who has to submit to the court or the tribunal, as the case may be, that why should this company go to the liquidation and how will the liquidation process go through. This is before even the liquidation starts, and at that point, along with the application for approving liquidation, they do end up submitting what is called as liquidator statement of affairs. Now, because this is prepared prior to the actual liquidation process, the numbers in this statement are kind of projections, they are estimates of what we will get once we go ahead with the liquidation process. So when we are liquidating, you are not going to run the business anymore. However, you are going to sell the assets. So the liquidator statement of affairs kind of gives to the court, to the members, to the creditor, whoever is the recipient of this statement, the estimated realizable value for the assets of the company and the estimated liabilities or estimated amount at which the liabilities will be settled, presenting at the end whether there will be some surplus or will there be a deficiency which has to be shared by the members, by the creditors, etc. So this is a statement which is prepared on an estimated basis and for which the institute kind of uses a specified format. This format comprises of around eight or so lists, and we will also solve in that manner. So when you are preparing a liquidator statement of affairs, you have to remember that this is prepared on a realizable value basis and on an estimated basis. Whereas as you will go ahead, once you prepare the liquidator statement of account, that is an actual position and that is prepared on an actual basis. So the list that we will look at over here is list A, which comprises of assets which are not specifically pledged. ASNP, assets not specifically pledged. What is covered in these assets? So for example, the company's assets might comprise of land and building, plant and machinery, stock, debtors and cash. However, this land and building has been given on a mortgage or given as a security for a loan. So in the event of a liquidation or in the event of recovery, these lenders can actually sell the land and building for the purpose of repayment of that loan. So this is not available for the other creditors of the company. It is primarily for the secured lender. Over here, you will cover assets, the realizable value for assets which are not specifically pledged. which means in our example, land will not be covered over here. However, plant and machinery, debtors, stock, cash, everything will be covered over here on an estimated realizable value basis. After that, in list B, you will show assets specifically pledged, like land and building will be shown over here. But along with that, you will also try to show that what is the realizable value of land and building. For example, that is 100 rupees. And what is the estimated value of the security, of the loan, of the secured loan, which is, for example, 80 rupees, which means is the land and building sufficient? The answer is yes. In fact, even after paying the secured loan, there will be a 20 rupee surplus. So there will be a surplus which will be kind of taken in the outer column in the liquidator statement of affairs. And in case there is a deficit, that is a shortfall. For example, this is 180. In which case there is no surplus. However, after paying the security as well, after using the security as well, 80 is still remaining. Now that 80 is kind of unsecured, and as a result, this will go as a part of unsecured creditors, which will appear in what you call as list E. Okay, so this is liquidators statement of affairs list B. At the end of list A and B, which are predominantly pertaining to assets, we need to show a statement showing gross assets. So the realizable value of assets not specifically pledged, assets specifically pledged, सबका total करना, that is just for disclosure. Similarly, you also have to later on give a disclosure for the gross liabilities. But what all will go in the liabilities? Well, there will be list C, which is the most important list in my opinion, which is on preferential creditors. What are these preferential creditors? Well, these are creditors which get preference in the course of liquidation process. For example, dues to the government. So if there are some taxes, duties, cess payable to the government will say, "Pehle mere ko pay off karo." Or if there are employees to whom their dues like salary, bonus, wages, provident fund is outstanding, subject to the specified limits, they are preferential creditors. Or expenses linked to investigation for liquidation, all of these are preferential creditors. They will be given preference. So if the company has to pay off, लाइन में खड़ा रहना पड़ेगा, सबको लाइन में सबसे ज्यादा पहले इनको जगह मिलेगा. So these are preferential. So over here we will study a little more detail about these individual items, but nevertheless this is preferential creditors. After the preferential creditors, in list C comes debentures, which are generally having a floating charge. If they have a fixed charge, they will be going along with list B, secured creditors. Debentures typically have a floating charge, and if they have a floating charge, these debentures will be covered in your list D. Sometimes along with these debentures, you also have accrued interest on these debentures. So the debentures along with the accrued interest will be a part of your list D. Then you have paid off all of these priority based creditors. Now comes the unsecured creditors, everything else which is remaining, maybe the regular trade payables, the outstanding expenses, the expenses which or the loans which are unsecured will also come over here, and secured loans, in our example that 100 and 180, this 80 will also come over here because it is unsecured. There might be a possibility where there is salary payable, which is to some extent a part of preferential creditors of 100, out of which probably as per the rules which we are yet to revise, 80 is preferential. Does that mean that the 20 is not to be paid? No, 20 will also be paid, but that will be treated as unsecured. So over here, when we look at unsecured creditors, all liabilities which have not been included earlier will be taken over here. It also includes a deficiency from list B and excess of salaries and wages over those included in preferential payments. After this, ideally all the outsiders or creditors should have been paid off, and after which you should be having money to pay off the members, which is the preference shareholders first and then the equity shareholders. Sometimes it might happen that you don't have the money, in which case there's a deficit, but if you have the money, that is surplus, then you will first pay off the preference shareholders, including arrears in preference dividend if any, and then you will pay off the equity shareholders. So the list F will be preference and list G will be equity shareholders, where you will give the paid up share capital of equity share holders. After this, if there is a deficiency, then a list H needs to be prepared. This is a statement of deficiency. Do we have to prepare the statement of deficiency in every question? No. If the question just says prepare the liquidator statement of affairs, it will end over here. You will just show the amount of deficiency and end. However, sometimes the question tells you prepare the liquidator statement of affairs and also show the statement of deficiency, or the deficiency account is to be prepared. Now, what is to be shown in deficiency? Well, deficiency is arising because of the liquidation process. We now kind of do a prequel. We try to go back and find out that why is this deficiency arising. Probably this deficiency is arising because you had losses in the past. So ideally your paid up share capital was, let's say paid up share capital was 10,000 rupees. So ideally you should have recovered 10,000. However, you are not in a position to recover that. You are barely probably able to recover 2,000 rupees, and hence 8,000 is the deficiency. Now, why is that 8,000 arising? Maybe even before the liquidation, the company was a perennially loss-making company. It was making a lot of losses, and as a result, the accumulated losses of the past can also contribute to the deficiency. Now, what all will be there in the accumulated losses of the past? The loss as minimum past 3 years you will start. So if the liquidation is starting 2020, then you will at least start from 2017 and then take the profits of 17, 18, 19, 20, etc. Minimum 3 years in the past you will start, and then take all the profits, all the losses, all the dividends paid, all the abnormal events that have happened during that 3-year period at least, and show it to the shareholders. Now that will typically give you the accumulated loss position as on the date of liquidation. However, on liquidation, it is possible that you might end up selling the assets at a lower price, or paying off a higher amount for the liabilities, or paying off some unrecorded liabilities as well, in which case you will get a higher amount of deficiency possibly. And hence the two reasons which contribute to the deficiency are the past accumulated losses, which you will show, as well as the gains or losses, as a case may be, on the liquidation process. So this will kind of reconcile and show a statement explaining the deficiency. This is to be prepared only if the question specifically asks you to. Achha, now before we proceed, we want to understand what is meant by preferential creditors. As we said, usually the common items are dues to the government, can be taxes, TDS, etc., GST, anything, can be salaries and wages, and can be expenses for investigation in the course of liquidation. We are focusing over here on salaries and wages. Salaries and wages, the law gives the limit. It says that, okay, it is salaries and wages are due to the employees, they are preferential, but not all salaries and wages. First of all, if there is any amount which is due to the directors ने company बराबर manage नहीं किया, उसके वजह से सब गड़बड़ हुआ, any dues which are due to the directors will not be treated as preferential. So directors, whether it is managing director, regular director, does not really matter. Directors dues उनको pay करने, but they will not be treated as preferential, they will be treated as unsecured creditors. So employees other than directors, yes. Achha, now within that, for every employee, the limit that is given over here is the outstanding salary for the last 4 months, or 20,000, whichever is lower. So for example, the employee's salary is, let us say, 3,000, and it is due for the past 5 months, which means 15,000 is due to him, or 20,000, whichever is lower, which is 15,000. However, this 15,000 is not rightly calculated because this is outstanding for 5 months. Ideally, maximum 4 months can be taken, and hence in preferential creditors there will be 12,000, and the remaining 3,000 will go as unsecured. This is for preferential creditors in the course of salary. We have given an example also over here which can be referred. So this is an employee. There are 5 employees having 2,500 of salary, which is outstanding for, let us say, 6 months, which is coming to 75,000. But out of this 75,000, we can say that for 5 employees, 2,500 per month into 4 months. So this is what, 10 into 50,000. Or for these 5 employees, the limit of 20,000 is per employee. So this is 5 into 20,000, which is 1 lakh. You will select whichever is lower, which is 50,000. So in the preferential, we will take 50,000, whereas 75,000 minus 50,000, which is equal to 25,000, will be taken as unsecured creditors. Okay, so this takes care of preferential creditors. We have also explained the statement explaining deficiency. This is to be solved if it is asked, which will go back at least 3 years. Okay. Now, what is overriding preferential payments? Before that, a couple of interesting points. Sometimes there are calls in arrears. In your balance sheet, you show the calls in arrears as a reduction of paid up share capital. But at the end of the day, what are calls in arrears? Calls in arrears have a debit balance and they are actually receivable. Like when you sell goods, you have money receivable from the debtors. Here, you have actually issued capital and you have money receivable from the providers of capital. And as a result, the calls in arrears over here are money to be receivable from the shareholders and hence will be shown as a part of your list A. Do not take it into list G. This is where students make a mistake. They kind of say that, okay, this is a part of share capital, this is receivable, and hence it will be like a asset for the liquidator, and hence it will be a part of list A. Second is liquidation expenses. Well, we are still at the start of liquidation, and hence we have to ignore the liquidation expenses for the time being. They will be considered in the liquidator's final statement of account. Right now, they will have no effect in the liquidator's statement of affairs because you are just at the start. You're just giving a projection of what will happen if the liquidation goes through. These expenses have not even accrued. Achha. Then there is something called as overriding preferential payments. Now, ideally, the order of liquidation remains fixed. However, the Companies Act is particularly worried about the future scenario, condition, position of employees, and hence the Companies Act says that if there is a workman's due, and that is going unpaid because the company does not have any assets, then even the security, which is ideally only for the secured asset holders, will have to be shared with the workmen. So for example, the company only has a secured asset which is in the form of land and building worth 100. Secured loans, for example, are 150, and workmen's dues like salary, wages, etc. are worth, let us say, 300. Let us say this is worth 90, the secured asset. Now ideally this 90 worth of secured asset will go to pay off, and there is no other asset with the company, for example, will go to pay off the secured loan. Achha, there is also, let us say, taxes due. There are taxes due, which is also preferential because it is payable to the government, worth of 200. Ideally this 90 is going to go in the payment of secured loan, and everyone else is going to go unpaid. Even the secured loan to the extent of 60 will go unpaid. However, the government over here introduces a forceful provision where it says that, well, if workmen's dues are not being met, then this secured asset has to be shared between the secured creditor as well as the workman. Remember, it is not with all preferential creditors, it is only between the workmen. Okay, if it is written in the law, the secured creditor has to accept it, and this will be shared in the ratio of their outstanding balances. So this 90 will be shared between the secured creditor and the workman in the ratio of 150 is to 300. So basically this is 90 into 150 upon 450. That's basically 1 by 3 ka ratio, and 90 into 300 upon 450. So basically 30 will be used to pay off the secured creditor, and the remaining 60 will be used to pay off the workmen. This is the provision of overriding preferential payments as per section 326 of the Companies Act. So this kind of largely takes care of the liquidator's statement of affairs. Next we go to the liquidator's final statement of account. So now we go from an estimated account basis to an actual account basis. So in case a question asks you to prepare the liquidator's final statement of account, this is an account that you prepare at the end of the actual liquidation process. After the court giving an approval, after the liquidator selling the assets, paying off the liabilities, making the calls as necessary, this is after the entire process gets done. So this is something which is prepared in a horizontal or a T format, like a receipts and payments account, where you take the receipts on the left hand side, the actual numbers, and the payments that you make in a specific order on the right hand side. So when we look at the receipts and payments over here in the liquidator's final statement of account, so this is a summary which is prepared by the liquidation at the end of the liquidation process. You will start with the available bank balance. So the format will appear something like this. This is an illustrative format. you will start with the available cash or with the available bank balance, and then you will take the actual realizable values of all the assets that you have actually sold, which as of now are not specifically pledged. This can include plant, machinery, stock, everything. So these are the actual values for the assets, and then secured assets. But when we look at secured assets, for example, land and building is given as a security for a loan, and the secured asset gives us 100, and the loan is worth 80, and hence the net 20 will only appear. In all of these cases, if there is any cost of collection, for example, debtors are worth 102 rupees, and 2 rupees is the cost of collection, then you will show 102 minus 2, that is net 100 over here. So if there's any cost of collection, it will be reduced from the respective item. So these are the typical asset collections. When you go to the payment, the first item that you will show, and you will go in this order, is the legal expenses. If there is any legal expenses which are to be incurred, you will take that. Second is the liquidators remuneration. A lot of questions do come in the exam only pertaining to even the liquidators remuneration. Just a second. Yes, so there will even be questions which are pertaining to only the liquidators remuneration. Sometimes the liquidators remuneration is a percentage of the assets sold. Sometimes it is a percentage of the payments made, maybe payments to the secured creditors, unsecured creditors, preferential creditors. Maybe it is a percentage of the payment that you are making to the members. So you will have to look at the facts of each question, and if required, even prepare a working note in order to determine the liquidators remuneration. Then you have certain liquidation expenses. This will be given to you in the question. So these are the three things. If there are any liquidation expenses, it will be given to you in the question directly. Then we have debentures. Now ideally we should have written preferential creditors, and you can, I guess it is possible, but in some of the institute solutions we have seen debentures coming first over here and then the preferential creditors, though in the order ideally preferential creditors will go first. But nevertheless, when you're preparing the liquidator statement of account, try to put the debentures including the accrued interest first. When we look at accrued interest, till what date will the interest accrue? Well, till the date of final payment of the debentures if the company is solvent, and if the company is insolvent, then up to the date of winding up. If nothing is given, you will take the interest up to the date of the final payment to the debentures. Then comes the preferential creditors, then comes the unsecured creditors, and then comes the payment to preference shares or the payment to equity shares. Now in my opinion, this is the calculation of this part, either the call money received from the contributors can be equity shareholders or preference shareholders, there is preference shares including preference dividend. Sometimes if there is any surplus, you can even give the money to the equity shareholders. So this is by equity shareholders, which can also come over here. This is like a refund or a payment which is made to the equity shareholders. Now in my opinion, one of the most tricky parts in this working may be to some extent the liquidators remuneration, but most likely this is the calculation of call money. There are two methods possible in this working. So if we go to see, you can take the help of two specific methods. You can have, let us say, a loss per share method, where we can take, an institute has used both the methods, the answers in both of them will be the same, where you will take, for example, the total paid up equity share capital. There can be various shares. For example, 1000 shares of rupees 50 each fully paid, 1000 shares of rupees 50 each, rupees 25 paid. So you will take the total paid up capital. For example, 1000 into 50 plus 1000 into, let us say, 25, which means this total, let us say, will come to 75,000. Now ideally jitna paid up share capital should be given. So you will compare this with the surplus assets, which can be given to the equity shareholders after paying preference shares, after paying all liabilities, surplus assets available to pay off equity shareholders. Sometimes it can be deficit as well. So if it is a surplus asset, let us say you have around 20,000 as surplus assets. So you will say, okay, that means for something which is worth 75, I can give only 20, and hence the total loss that the shareholders will suffer is 55,000. Okay, now this is a total loss. You will divide this by the number of shares in order to find the loss per share, and the number of shares are 2000, and as a result, if I take 55,000 upon 2000, the loss per share is, I guess, 27.5. So this is a loss per share. Now if you want to find how much is a refund or how much is the call that is to be made from each shareholders, you will take the paid up value per share less the loss per share. So जितना भी paid up value है उतने उसके सामने loss share करना है. So this is 50 rupees. for the first 1000 shares, 50 rupees is a paid up value. For the next 1000 shares, only 25 is a paid up value. So out of 50, 27.5 is a loss, and hence for the remaining 22.5, there will be a refund. This will be a refund on a per share basis, whereas here there is 25 rupees, but 27.5 is a loss, and hence 2.5 is the amount of call to be made. You will multiply this by the number of shares, that is 1000 and 1000, and hence on a total basis you will have a total refund of 22,500 and a total call of 2,500 to be made in order to ensure a fair distribution. So this is one of the methods possible. The other method which is possible is a notional call method, where we say that forget this entire working, let us assume we make a notional call, which means right now you have surplus assets to distribute. How much surplus assets do we have? Well, we have surplus assets for 20,000. Ajay, can we generate more assets? Yes, by making a notional call. So this is a call which is notional. Achha, for the first 1000 shareholders, they are fully paid, so no call. However, for the next 1000 shareholders, 25 is still to be paid, and hence 1000 into 25, so your notional call will be 25,000, and hence the total assets available for distribution is 45,000, and hence 45,000 divided by 2000 shares. Now all the shares are fully paid, so 45,000 divided by 2000 shares, which is 22.5. So for the first group of shares which are of rupees 50 paid up, there is no notional call, so they will directly get the refund of 22.5. There is no notional call. However, for the second shares which are 25 paid up, there will be a call of 25 and then a refund of 22.5, and as a result, if you go to see the net 2.5, so rather than making a call of 25 and then giving a refund of 22.5, we will just make a net call of 2.5 and give a net refund of 22.5. So this, as you can see, is exactly the same. I've just tried to run you through both the methods. Institute in some questions has taken the loss per share, some questions have taken the notional call. You can take any of the two in the exam, and you can be rest assured that the answer will remain the same. So this is something that you have to be careful about. Also, while calculating liquidators remuneration, in certain cases the liquidators remuneration is a percentage of the disbursal that you are making to the shareholders, and let us say you have only 30,000 rupees to pay the shareholders. So you will say, okay, 30,000 into, let us say the liquidators commission is 3%, so 30,000 into 3% will give you the amount to be paid with the liquidator, but you don't have that much of money, you just have 30,000, and hence 30,000, let the amount to be paid to the shareholders be 100, so the liquidators remuneration will be 3, and hence the total is 103. So if 103 is equivalent to 30,000, then 3 is how much? So that is basically 30,000 divided by 103 into 3, and that will give you the amount to be paid to the liquidator. So I mean, this is one adjustment that you might have done, so around 873 or something, and 30,000 upon 103 into 100, that is around 29,000. 126 or 27 is the amount to you paid to the shareholders. Okay, so this takes care of the second part, liquidator statement of affairs, and then I would rate one of the most important part over here is the B list contributories. Now there have been two questions that have come in the recent past, in the last 1 year or so, 2 times exam questions have come on B list contributories, and I would definitely rate this as important. So what do you mean by B list contributories? What do you mean by A list contributories? Typically what happens is, in case of liquidation, if the money falls short, then the liquidator can go to the shareholders and recover that money. But as per company law, the shareholders are going to pay money only to the extent of their face value. Beyond the face value, they are not going to pay any money. So if there are, for example, 1000 shares currently, 1000 shares which are at the rate of rupees 100, however, out of this 100, this is only rupees 80 paid, which means we can actually go to this 1000 shareholders, and maximum the liquidator can recover 1000 into rupees 20, the unpaid amount, that is 20,000 rupees. Acha, what can happen is, I make the call, so these 800 shareholders kind of pay that amount, but for the 200 shareholders, 200, so this is existing 1000 shareholders. Ideally I need 20,000 rupees. 800 shareholders pay that. So this is 800 into 20, and hence 16,000 is received. Their liability is discharged. However, these 200 shareholders are either untraceable or they are insolvent or whatever it is. We are unable to recover the money from them. And as a result, if I am unable to recover money, I will just, as a liquidator, be a little sad and move ahead. Well, the law says no. These are A-list contributors. These entire 1,000 shareholders, that is 800 and 200, are A-list contributors, which are existing shareholders. However, if you are unable to recover money from the existing shareholders, for example, for these 200 untraceable shareholders, you will go back and see who was the past shareholder. The law allows you to do that. Sir, but why the past shareholders have already sold? Yes, but sometimes the law believes that if you see that the company is under liquidation, you might deliberately sell it to someone who is either on the verge of insolvency or who is untraceable or who is residing in a jurisdiction from which you cannot recover money. And as a result, you might have entered into a transaction to save your liability. And hence, the law permits recovery of money from the past shareholders subjected to certain conditions, provided the existing shareholders, that is these 200 shareholders, are not able to pay the call. Now, what does the law mention? Well, the law says that in the B-list contributors, you can include only those past shareholders who have transferred their shares within 1 month prior to the date of liquidation. So, for example, if the liquidation happens on 1st of April 2020, then the B-list contributors will comprise of the past shareholders for these 200 shares who have transferred their shares between 1st April 2019 to 1st April 2020, let us say, not before that. If they have been transferred before, the law says maybe you did not have a bad intention, you did a genuine transfer, and hence you are no longer liable, the existing shareholder should be liable. So if you have transferred in the recent past, that is in the last 12 months, then your collar can be caught, provided the existing shareholders did not pay money. So over here, if the existing shareholders did not pay money, then you will recover money from the past shareholders. Acha, kitna paisa recover karega from the past shareholders? Well, the law says that is up to the liability that was outstanding on the date when you were the shareholder. So, for example, you had shares which are transferred within the following dates. So, let us say you have been given the dates as 1st February 2019, 1st May 2019, 1st October 19, and 1st February 20. So these were shares held by, let's say, A, B, C, and D. These were the past shareholders who have transferred these shares. And kitne 200 shares hai, right? So let's say this is 20 shares, 40, 60, and and 80. So these are your total shareholders of the past. So these are the number of shares, and let us say the liability that was outstanding was let us say 3,000 rupees, became 5,000, became 8,000, and became 12,000. This was the liability outstanding as on date, which means what will happen? The law says that okay, you will have to contribute if the existing shareholder is unable to pay, but the past shareholder will say that I will contribute only to the extent there was liability existing on the date when I was transferring. If you took as a company new liability, then how can I be responsible? And hence, while doing this calculation, you will have to check the amount of liability that was outstanding as on the date when these shareholders transferred their shares. So what we typically do over here is we will first write a note and say that, well, these shares were transferred prior to 12 months, and hence this shareholder is not going to be a part of B-list contributor. He is not going to contribute anything. So everything will be between B, C, and D. For example, B, C, and D ke existing shareholders have not paid any money. So if the existing shareholders of B, C, and D, which are a part of this 200, had they paid money, so even they will not be held responsible. So what we will do over here is on 1st May 19, 1st October 19, and 1st February 20. What is the additional or the incremental liability. In the first day, you will take the initial, that is 5,000 was a liability, and who are the shareholders on 1st May? Your thought would be only B is a shareholder. Galat hai. Even C would have been shareholder because he transferred the shares on 1st October. Even D would have been shareholders because he transferred the shares on 1st of February, and hence they would also be the shareholders on 1st of May. And as a result, the shareholders and the appropriate ratio in which this loss has to be shared or this liability has to be shared, the shareholders were B, C and D, and the number of shares are 40:60:84:6:8 or 2:3:4 will be the ratio. The additional liability then would be 3,000. Sir, how 3? 8 minus 5. Liability is always as on date. So if as on date there is 8,000 of liability, out of which 5,000 has already been considered, then the remaining 3 would be during this intermediate period. And in this intermediate period, P was not the shareholder, but C was, D was, and as a result, this has to be shared in the ratio of 6:8 or also 3:4. And lastly, the last set of liability, which is 4,000, arises when only D was a shareholder in the last 3 or 4 months. And as a result, if I were to share the loss between B, C and D, well, the loss over here will be in the ratio of their shares. So as a result, this 5,000 will be shared. अगर अपन total करें to let's say 4, 6, 8. So this is 5,000 into 4 upon 18. So I think 1389. I hope the calculations are correctly done. 5,000 upon 18 into 6. This is 1667. We can just ignore that rounding of 5,000 upon 18 into 8, which is 2222. Rounded off. Then you have 3,000 upon 14 into 6, 1285, 3,000 upon into 8, 1715, and lastly the entire 4,000 will come over here. So this is the total liability which was existing, and hence B will bear 1389, 1667 plus 1285, that is 2952, and triple into 1715 and 4,000. So this is 7937. So will I have to pay this? This is your share of the liability. Ideally, yes. However, I will contact my lawyer and I will say that, do I have to necessarily pay this? The lawyer says, how much is your unpaid amount? Well, B will say that I hold 40 shares, 60 shares and 80 shares. Acha, on every share 20 is unpaid. So 40 into 20, if I'm not wrong. ये कितना है 200 into 20, I think ये 4,000 ही है. So 40 into 20, so this is only 800. 60 into 20, 1200, and 80 into 20, which is 1600. So well, the share of the liability might be more, but we will be paying maximum this amount. So it is not necessary कि यहाँ पे we have taken numbers in a way कि ये unpaid amount ही आए, but it is possible that some of them may be unpaid amount, some of them may be the liability amount. So this is how your working will be done for a B list contributory. This is something which is important. I'll just glance through it. Contributor is referred to the shareholders of the company. There can be A list, there can be B list. B list are the prior, provided the existing shareholders have not paid, and these transfers were made within 12 months. B list contributors can be called up to pay the unpaid amount maximum, provided the existing assets available with the liquidator are not sufficient to pay and the existing shareholders fail to pay the amount due on the shares to the liquidator. If both these conditions are satisfied, then the amount to be paid by the B list contributors will be the lower of the proportionate liability, like we just calculated, that existed on the date of the transfer, or the uncalled or the unpaid amount, whichever is lower. Okay, so I guess that takes care of liquidation. I hope these 3 parts that you have are fairly clear. Thank you very much for your time, and all the best.